On this channel, we usually focus on legendary investors and the strategies they use to deliver outsized returns. But that doesn't mean I haven't been paying attention to the coverage of the Pandora Papers. Anything to do with taxes, really, is of great interest to me, because the lack of a solid grasp of the intricacies of taxes can tarnish a great investment record. Accountant fees and tax penalties sometimes exceeding the actual profits realized. The key is to contribute your fair share and not underpay, but also make sure you don't get taken to the cleaners. With things like the Panama Papers or the Pandora Papers, admittedly there's also an element of gossip in seeing the tricks public figures like Shakira and Ringo Starr use to minimize their tax bill. I've been watching the coverage and conducting my own research, but I think the topic, in its complexity, makes it very difficult to accurately convey the heart of the story. So what I want to do here is give you a concise overview of why people use these structures, more specifically, trusts in U.S. states like South Dakota, explain why that's potentially problematic, and dispel some misconceptions. We'll be going over A. Tax haven considerations, B. The asset protection angle, and C. The dual-tiered system affording VIP treatment and complete privacy to those wealthy enough to use these trusts. A. Tax havens. I think something that needs to be communicated is the fact that a tax haven can have a non-zero tax regime, or even 10 or 20% tax. In fact, many musicians, actors, and businessmen throughout the years have become tax exiles in regions not usually associated with extremely low taxes. For example, back in the 1980s, Sean Connery left the UK and first moved to France, then Spain, and later the Bahamas. Rod Stewart similarly moved to Los Angeles and Cat Stevens to Brazil. In 2013, French actor Gérard Depardieu became a tax exile in Russia, and Bernard Arnault, the world's third richest man, briefly considered obtaining dual French-Belgian citizenship for tax purposes. The U.S., with structures like South Dakota trusts, offers similar incentives. A somewhat attractive tax system coupled with stability and a powerful and alluring country brand. Sure, South Dakota has no state income tax, no inheritance tax, and no capital gains tax, but there's a caveat, namely the fact that the trust structure is nonetheless liable for federal income tax. And unlike the tax bracket for individuals, these trusts use extremely compressed tax brackets, reaching the maximum long-term capital gains tax rate of around 20% after just $13,000 in change. So let's say your South Dakota trust bought Tesla shares at the lows in the spring of 2019. You see the post-split adjusted share price surge from $45 to over $800. You think to yourself, 18x, huh? I guess the stock has had a good run, but now I'd rather realize these gains and use the proceeds to invest in something else. So you sell. Or rather, you, as both the settlor, the person who sets up the trust, and as the beneficiary, have your South Dakota trust sell the shares and realize a long-term capital gain of $100,000. This means the trust is on the hook for a baseline of $1,583, and then 20% of everything in excess of $13,250. So the trust has to pay $1,583 plus $17,350, which comes to $18,933 in long-term capital gains tax. This on top of property taxes if the trust holds any real estate assets, because, according to Jesse Little, a senior director of wealth planning for Wells Fargo Private Bank, you can't get around the rules of each state. Property tax is applied regardless of who owns the property or how it is owned. So there's that, and also the fact that if the trust makes any distribution of the interest, dividends, profits derived from realized capital gains, etc., then you are also liable to pay taxes on those at the applicable tax rate in your jurisdiction. The rate you pay is therefore determined by your tax residency, whether that be California or Monaco or St. Kitts and Nevis or wherever. Still, while not entirely tax-free, depending on the specific setup within the overarching framework of an individual's financial affairs, these structures can present tremendous advantages. Advantages that do not easily present themselves to regular people like us. Hence the understandable public outrage and the drive behind this 2.9 terabyte data leak. B. Asset protection. Another point I would like to make is that no, assets in a South Dakota trust are not immune to a divorce settlement. Well, unless you've got a solid prenup or postnup in place, that is, but that's an entirely separate issue. Under certain specific circumstances, a South Dakota trust can indeed work in keeping your assets safe from creditors, but by no means does it offer blanket protection after a mere 2 years, as is sometimes claimed. It's more complicated than that. You see, this so-called 2-year rule refers to the statute of limitations on fraudulent conveyances, also called fraudulent transfers, which arise when a debtor moves assets into a trust with the intention of hindering or avoiding creditors. This applies to any and all creditors, including unknown or unforeseen future ones, and merely being able to prove the debtor consulted with a professional for the purpose of asset protection can be enough to breach the trust. Furthermore, the look-back period is 4 years under the Uniform Fraudulent Transfer Act, and 10 years in case of bankruptcy, which happens fairly frequently in these cases. And last, but not least, U.S. law actually imposes restrictions on so-called spendthrift clauses, that is, clauses protecting assets from creditors. According to the Restatement of the Law of Trusts, 156.1, where a person creates for his own benefit a trust with a provision restraining the voluntary or involuntary transfer of his interest, his transferee or creditor can reach his interest. Translated into plain English, U.S. law does not recognize spendthrift clauses in cases where a person who sets up the trust is also a beneficiary. Assets you put in a trust for your kids are protected, but not assets you put in a self-settled trust, a trust in which are both the settlor and beneficiary. Now, some states like South Dakota, Alaska, Delaware, Nevada, etc., have tried to sort of overwrite these common law provisions. But the U.S. Constitution has this thing called a full faith and credit clause, which essentially means that a judgment issued in one state should be valid across all 50 states. This means that for this asset protection strategy to work properly, you probably need to reside in one of the states I just mentioned, or in others like Utah or Michigan, but not New York, Florida, or California, for example, or if you live overseas. Other considerations are whether the self-settled trust in effect acts as an alter ego to the settlor, and whether or not there is a tie to these domestic asset protection trust states, DAPT states for short. If the trust is for all intents and purposes an alter ego, then that's no good, and it's also a problem when the debtor has no defensible ties to the state where the trust is located. This presents quite a conundrum, especially when it comes to real estate, because of physics. After all, You're not realistically going to be able to airlift a Malibu mansion to Nevada, are you? So in many cases, unless you're being represented by an elite litigator and are dealing with an opponent with a perhaps less than stellar legal team, then odds are the trust will be cracked open. But don't take my word for it. Should you look up Jay Adkisson, the Warren Buffett, the Michael Jordan, the Tiger Woods of asset protection, and read his column on the Forbes website, you'll be shocked to find out that the picture I just painted is probably pretty accurate. C. VIP treatment / complete privacy. This is the premier reason the ultra-rich are so fond of places like South Dakota and Nevada. For example, Horst Happel, an orange juice magnate from Brazil, is one of the names mentioned in the Pandora Papers. According to the Washington Post, in 2016, Happel and others paid an $88 million settlement to the Brazilian government for allegedly colluding to underpay local farmers. He set up a trust in South Dakota in 2017. Considering the amounts involved, I presumed he created the trust to avoid paying, so I was expecting the Brazilian government to do what U.S. judges do in cases involving offshore trusts: ask the debtor to repatriate the assets. Most debtors predictably claim they don't have access to the money, and end up being held in civil contempt and spending a couple of nights in the big house at the courtesy of taxpayers. Once inside, they invariably realize you can't put a price tag on hot showers and real food, and decide to bring back the funds. So, was this the case with Happel? Actually, I don't know, because there's hardly anything on him anywhere on the web. Not a single picture, and very little information, even in the Brazilian media. But I did find out that his and his company, Bacitru's, share of the $88 million settlement was 350,000 Brazilian reais, around $100,000 at the time. To be honest, I was expecting a much larger amount, in the tens of millions of dollars. But the fact is that this wasn't Happel's first rodeo, so to speak, as according to the Anchorage Daily News, in 1991, he agreed to pay $250,000 to the U.S. government to settle allegations involving limits on orange juice futures. This should have given pause to the people who helped him set up the trust, but clearly it didn't. This, in my view, is the main allure of a South Dakota trust. No questions asked VIP treatment coupled with absolute privacy, even if you happen to have a less than pristine background.